So today we're talking with Matt Balderston. He's a senior advisor at Pure Financial. Thanks for joining us today.
My pleasure.
So let's jump right in. What does total return mean?
Total return is getting income from your investments that isn't necessarily created by those investments. You talked already about dividends and interest income from bonds. Well, there's also the principal of those assets, selling them to some extent, whether it's through rebalancing or actual just sales for need, that can really help diversify how you create that income.
Now, that's a little bit different than maybe our parents grew up with, which was invest, live off the interest and dividends, and don't touch the principal. So this is a little bit different way to go.
It definitely is, but the principal, if you want to look at it this way, is where you started when you retired, but it is going to appreciate. So taking some of that appreciation off the table is still leaving the principal intact.
So then would you say that a total return approach would be more risky or less risky than, say, just a fixed income approach? I
think it's less risky. You made a comment earlier, as did Joe, that when you're completely focused on dividend-producing stocks and interest-producing bonds, you're leaving out huge amounts of the actual investment marketplace. And a good statistic that kind of illustrates this is after the financial crisis in 2008, about a year later, 57% of dividend-producing stocks either cut or eliminated their dividends. And if that's not risk, I don't know what is.
Yeah, you're not kidding. All right, so let's talk about a total return. So how do you implement that? Like, let's say maybe you'd want to do a total return and you use what we might call the 4% rule. How would that work?
Well, with the 4% rule, the idea is to try to keep your withdrawals within 4% of the total value of your portfolio. If you can get a rate of return a little better than that, that can be very helpful because you do want to keep up with inflation. So if the account is a little higher the following year than it was the year before, then that 4% is a larger amount that you can draw. There will, however, be years where the portfolio is down, in which case you can make adjustments through you can spend less or spend more during the years when the market's up higher. So there's a lot more flexibility in that, in my opinion.
And some people like to do it a little bit differently. They might say a flexible spending approach where if the market's doing well, maybe they'll spend a little bit more that year. If market's doing not as well, they might spend less. So talk about that.
Well, that actually is the closest that we can compare to when you're working, whether when your income goes up or when one of two spouses gets laid off or a cut in income or there's an emergency. Yeah, you adjust your spending. And so we're already trained to do that. Why not do that to some degree when you're in retirement based on the performance of your portfolio?
So in your opinion, then, is the total return method a better way to go than maybe just looking at fixed income?
I believe so, yes. And I know you're a big fan of this too, is that it's also a lot more tax efficient without going into huge detail. If you just take dividends and interest, every penny of that is taxable. Where if you're selling part of your assets, you can have a lot of basis return and keep your tax rates really low.
Well, and I think that's a good point because with dividends, they can be qualified. You can get capital gain treatment. But when you're selling chunks of your portfolio, it can be long-term capital gain, which is a lower tax rate than ordinary income.
And some of it is basis, which is tax-free.
Right, right. And when you're thinking about creating retirement income, you want to have some tax efficiency.
Absolutely. You keep more of it in your pocket.
Yeah, so it really is a way to make it a little bit more tax efficient.
Which stretches it longer.
Yeah, exactly. Well, Matt, thank you so much for joining us.